the next thing is one of my favorites, and that is openness or transparency. Openness or transparency. This means open and clear disclosure of relevant information to all stakeholders and not concealing information when it may affect decisions. Very, very important. So organization must be open, must be transparent to communicate information to the stakeholders of the company. So if it is about the shareholders, we must make sure we provide them with the information that they need so that they can make the right decision. If it is about our customers, we must make sure we give them the information they need to be able to make their decision. If it is about our suppliers, our finance bankers, we must make sure we provide them with the decision. We shouldn't conceal any information. One of these things is tested with human beings if you're going to have any insurance, right? So because people want a lot of money, they would want to have about 4 insurance companies insuring for the same thing, right? So when you're going to undertake a policy from an insurance company, they are going to ask you, do you have the same policy with any other insurance company? Because otherwise you'll be making money at the expense of them, so that they will know how they can schedule your premium, they can fix your premium and all other things. But when it comes to organization openness, there are a couple of exceptions here. The reason is that the fact that a company has to be open does not necessarily mean that it must make all the information out. Because imagine, like in one of the videos I was telling you that if another institution rises today and provides ICA courses online, which we know definitely will happen going forward, we have a backup plan, we have a strategy that we are going to put in place. Now that strategy is just within a couple of people, and that's it. We can't share it with our customers, we can't share it with our bankers, we can't share it with some people. So the transparency here has to be careful. Now, if it is a decision about the competitiveness of the company, enable us to gain competitive advantage in the company, then the organization may conceal it. So the fact that we should be open, we should be transparent, does not mean we should commune our future strategies to you. No. We should be open in relation to the disclosures that we make in the financial statement, disclosures that we make in the narrative notes, disclosures that we make in the director's report. These are the things that we are supposed to be transparent on, so that we present a true and fair view of so that the financial statement and reports presented represent a true and fair view of the company. Why do you think the organization has to be transparent? Why do you think an organization must be open? Why do you think the organization should not conceal critical information that will help stakeholders in the making of their decision? Why do you think so? There are a couple of reasons. One, to solve the agency problem. Because the management are employed by the principal, who are the shareholders of the company. For that reason, it is your responsibility to report to them. Okay, it is believed that management uses the money for their own thing, paying themselves big bonuses, traveling out, driving big cars at the expense of the shareholders' money. But openness and transparency simply means when we prepare the financial statement to provide everything, so that we see how everything is being done in the company. We see how everything is being done in the company. 2, to confirm the level or strength of internal controls for reliability. Very important. Then, market prices of shares. When we are transparent about our transactions, about our financial statement, it's not fictitious, it's going to affect our share prices. It's going to have an implication on our share prices, because the kind of implications people have in relation to the information that we put across there will affect us in relation to the kind of thing that we do, or the value of our share prices. But as I mentioned, there are circumstances where organizations cannot be open. Organizations cannot be transparent. Organizations will conceal a couple of information. 2, to be specific, and I've mentioned this already. Number 1, the future strategy of the company. So, Nhyira, what will you do if another company or another institution renders courses online, what would you do? That is future strategy. We can't communicate that to the shareholders, or we may not communicate that to all our stakeholders, right? Because when we do that, meaning that they will pick that up and use it when they are launching, and they will run us out of business. 2. Confidential issues relating to individuals. Confidential issues relating to individuals. So it's very important we conceal some information, because remember, an organization has independent and then dependent, or has directors and then non-executive directors. So we have executive directors, EDs, and then non-executive directors, NEDs. So the independence of the non-executive directors will enable the company to really achieve the goal of what? Transparency and what? Openness. But most importantly also, the fact that we have to be transparent does not mean every individual of the company we bring out their information. Like we publish financial statement, then the MD salary is part of the published financial statement. No, that cannot be made public, right? It's not done. Okay, it's not done. It may not be done. We just write salary of the entire management, but as to the breakdown of it, it may not be done for what we are making in public, but it may be done to detail to the shareholders at our annual general meeting. So that is the second thing: openness and transparency. What do you think? Fairness and openness, which one is easy to be done? You want to treat people fair, but it's judgmental. But openness, you've got to be transparent in everything, because it's critical. The third one is probity. Probity is the same as honesty. Probity is the same as honesty. This means telling the truth and not misleading shareholders and other stakeholders. Very, very important. For an organization that is ethical, it must be an organization that is honest. Tell the truth. Don't mislead the shareholders. Don't mislead the stakeholders of the company. That will affect us as a company. So we have to find out, are we being honest with our shareholders? Are we being honest with our employees? Are we being honest with our customers? Very, very important. Very, very important. That is the issue about honesty. Then, next one is responsibility. Responsibility. This means management accepting the credit or taking blame for governance decisions. So management has to take responsibility if things go right or wrong. Responsibility. So to be responsible is to take full charge, to be accountable for the actions or decisions that you make as an individual. So management must be responsible for their action. They must take credit when the thing goes well, and they must take the blame when it doesn't go well. Very, very important. That will mean that they are ethical. So if, for instance, we arrange that we're going to have a one-on-one session, and something happens, and in a certain week I couldn't hold a one-on-one session with you, I shouldn't say that I called you, you did not pick, or you were not online. No, I'm not being honest there. I'm not truthful. I'm not telling you the truth there. And at the same time, I'm not taking responsibility, because you were online, I wasn't online. You tried to call me, my phone was off, but now I'm telling you that I tried calling you, your phone was off. So when that happens, it means I'm not taking the blame for the decisions that I make as a manager. The next thing is accountability. Right? Now, accountability goes with responsibility, right? Because anything you are responsible for, you must account for it at the end of the day. So if I give you the responsibility to manage this company, at the end of the day, you must account to me how you manage the company. So accountability is also something that guides us whether we are ethical as a company or not. So accountability. This refers to whether organizations or its directors are answerable in some way for the consequences of their action. So the accountability is a platform where we become answerable for the actions we take. Why did you do this? Okay, when you did it, what happened? You provide a report on all of these things. Now, there are a couple of things we'll be looking at later on in governance, about how governance developed, and there were a couple of committees that were put together, and one of those committees is the Cadbury Committee, which looked at the development of governance, and in their report they stressed that making the accountability work is the responsibility of both parties, that is the shareholders or the stakeholders and the directors. So to make an organization accountable, to make the government accountable, it is both the government and then the people. So if the government itself doesn't create systems or if the company itself doesn't create system which will make it accountable, which will make it voluntarily accountable, then accountability will not be seen. Then if stakeholders also don't demand from the management, from the directors to account for their action, then accountability will not work. So the Cadbury report suggests that to make accountability work in organizations, it has to be from the both parties, the directors of the company as well as the stakeholders of the company.